Welcome to the Three Edge Week in Review for the week of January 8th. I'm Fritz, Folts, a Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, Chief Investment Officer and CEO here at Three Edge Asset Management. And looking back on 2023, it may be best remembered as the year that the recession that most everyone expected never materialized. Throughout last year, inflation continued to decelerate, while both the economy and the labor market remained resilient, even in the face of the Fed's aggressive monetary tightening. So today, Steve and I will discuss whether the recession that most everybody thought was inevitable last year has been avoided completely, or has it just been delayed? It certainly was the case that in the final 2 months of last year, the consensus among investors shifted dramatically, away from the narrative wherein the Fed would need to keep interest rates higher for longer to a new narrative of a Fed pivot and a belief that the central bank was on the verge of sticking the landing by taming inflation without causing an economic recession. So now, here we are, new year, and investors are left wondering whether we can put the fear of a recession behind us for good, and the Fed can even begin to cut interest rates as soon as sometime in the first quarter of 2024? Or is a recession still in store for the U.S. economy? So let me bring Steve in here now. And Steve, as we know, last year, overwhelming consensus was that the Fed was raising rates aggressively. They were reducing the size of their balance sheet to seek to tame inflation. And at one point, inflation had even reached 9%. And so everybody thought, well, a recession in 2023, almost inevitable. And yet, the economy and the labor market remained resilient. GDP growth is going to look pretty good for last year. So first, how did that happen? And second, have we actually avoided a recession altogether, or do we still expect a recession here in the U.S. perhaps this year?
Well, Fritz, by itself, the Fed's monetary policy was enough to cause a recession. We had historically sharp rise in interest rates, both in the short and the long end. We had a sustained inversion of the yield curve. We had quantitative tightening where they're actually withdrawing money out of the system. And in the past, whenever we've had these conditions, we have never avoided a recession. Now, having said that, I can think of many cycles in the past where I'd read an article in the Wall Street Journal and would say, look, these leading indicators, the inverted yield curve, et cetera, they don't matter anymore because, look, we haven't had the recession. And the problem was that the recession eventually did come, but it was often delayed. And one of the reasons is that recessions can often be delayed even after the Fed tightens monetary policy because monetary policy works with a large and variable lag. And often the delay between when the Fed acts and when it hits the real economy is longer than what most people might expect. But there's a second reason that pertains particularly to the year 2023. And to show that, I want to bring up this chart. And I should say this chart was inspired by a similar chart that I read in a Lynn Alden newsletter, so I thank her for that. But it showed how the monetary policy of the Fed and the fiscal policy of the U.S. government and the Treasury are acting in opposite forces and counteracting one another. And you can see from this chart, when you look at the green line, that's the monetary policy that the Fed produces. When the line is above the zero, that means it's adding liquidity into the market. It's stimulating. When the line is below zero, it's taking money out of the economy. It's draining liquidity. It's tightening. Similarly, the red line shows a certain perspective on fiscal policy. And it shows when it's either draining liquidity or adding liquidity. And you can see that when the Fed was creating tremendous number of reserves, counteracting COVID and trying to stimulate, that money did go into the markets and inflate asset prices, but it didn't go in the real economy. Now, fast forward to 2023, we have the quantitative tightening of the Fed. The balance sheet is shrinking. That would normally be crunching the economy. We'd have a major credit contraction causing a recession. But look at the red line. It's above, completely offsetting all of the tightening that the Fed did. So what's going on here? What's going on is that when the Fed created all those reserves in the first place, instead of those reserves ending up in the real economy, they ended up on balance on bank accounts that the banks had and the Treasury itself had with the Federal Reserve Board, earning interest from the Fed rather than putting it in the real economy. And that's often called reverse repos. It's a technical term, but it's basically taking all that money, keeping it in an account at the Fed, earning interest off it, keeping it out of the real economy. And then this year, when the government is in such debt and the Treasury had to issue lots and lots of debt to try to fund the deficit, it very cleverly issued mostly Treasury bills, which used a lot of the funding that was sitting in those repo accounts to fund the debt. And that was a way to move liquidity back into the economy and counteract what the Fed was doing. So the real issue is that this helped delay and help mitigate a lot of the tightening factor of the Fed, but it didn't eliminate it permanently because the Treasury is going to still have to go out and borrow on a periodic basis. The deficit is high and growing. And as it exhausts the balance of those repo accounts, it no longer will be able to offset the quantitative tightening. So the Fed will have a big decision to make. Are they worried enough about a recession where they reverse policy and stop the quantitative tightening and start lowering interest rates rapidly to avoid a recession? Or are they worried more about inflation rebounding and they won't budge and they'll keep their policy intact? Even if they do ease up, what's happened in history is that most all the times when the Fed has eased up, they've done it too late. And by the time they've done it, the recession has already started or it's close to starting.
All right. This is very interesting. And I actually have a follow-up question that focuses on this difference, the difference in the impact between monetary and fiscal stimulus. And as you said, during the pandemic, we saw, aggressive easing of monetary policy by the Fed. And as you mentioned, it served to raise asset prices, right? So stocks went up, bonds went up, real estate went up. Basically the price of everything went up. And so, but when we look at fiscal stimulus by the government, that tends to actually make its way into the real economy. So my question is that always the case? Is monetary stimulus always really just raising asset prices and not make its way into the economy? And then the fiscal stimulus is the way that the government can stimulate the real economy? Is that always the setup, or can it be different?
It can be different. It's not necessarily so. But the reason why that has been the way that the mechanism has worked over the last few months and years is precisely because when the Fed was literally printing money out of thin air and using those reserves to buy bonds from banks, put it on the Fed balance sheet, and have that money released from the Fed into the banks have a choice. Either they can put it in the real economy and send lots of loans, or they can keep it in an account with the Fed and earn interest on it. And it's precisely that second choice that they made in a large degree. And that's why we have these big buildup of multi-trillion-dollar balances with the Fed in these reverse repos. So yes, what the Fed did, printing all that money, did elevate asset prices because they artificially raised bond prices, which then artificially raised stock prices and many other assets. But the money didn't go in the real economy. When the government came in with their multi-trillion-dollar stimulus plans, that money directly went to consumers, directly went into businesses. And that's why we had a rebound from the pandemic, but also why all that money coming in so quickly really overwhelmed the supply. The supply didn't grow as quickly as the money came in, and that's why we had inflation.
All right, excellent. Okay, so we find ourselves here at the beginning of 2024. And so based on what we've discussed here today about the offset from fiscal policy to monetary policy, how might investors think about, organizing their portfolio at this point?
Well, wouldn't it be nice if we could just all relax and say, look, the Fed did a great job. There's no recession. There's not going to be a recession. Let's just put all the money in equities. We're going to have uninterrupted growth. We've got low unemployment. The economy is growing in a decent way. Everything seems pretty good. That would be That would be a nice, easy way to proceed. But problem is that a lot of the actions certainly delayed the recession, but did not necessarily avert it. And there's no guarantee that even if the Fed does ease up at this point, and we do have rate cuts this year, that it'll be in time to avoid a recession, because when the Fed acts, there's always many months lag before it actually hits the real economy. So the real answer is that we think it's too complacent to just sit back, not worry about a recession, and put all your money in stocks. We think that's not responsible. We think you have to at least plan for the possibility that we do get a recession in 2024, given that a lot of the markers that point to recession haven't gone away yet. They've just been lagged. And so what does that mean? That means it's good to diversify against a possible recession using some treasuries, using tips, using gold, and using undervalued equities. And in that way, if this can continue for a while, then you can participate, but not at the full risk of someone who's just very complacent. I should also point out that for those that want to stay fully invested until the recession comes, well, here's the bad news. The market almost always starts to fall several months before the actual recession hits. So by the time you see the whites of the eyes of the recession, it would be too late to get out of the market.
Yes, don't confuse the market with the economy.
Right.
Very true.
You've said that very often, and it's been true. Good reminder.
All right. Well, great, Steve. Thank you. Thanks for your insight. I definitely believe 2024 will prove to be an interesting year in the markets, and we look forward to being able to keep our listeners informed throughout the coming year. So that will do it for Steve and me for this week, but we'll be back again next week with another edition of the 3Edge Week in Review. As a reminder, all our videos always available on our 3Edge YouTube channel. And if you think you know someone who might enjoy and benefit from these videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.